and welcome to the Weekly Watch, where we help you cut through the noise with our quick take on the biggest events moving global markets. I'm Imogen Bachra, rate strategist, and I'll be standing in today for John Briggs. Before getting into it, please remember to subscribe to our channel so you can get the latest episode the moment they're published, and hit the like button so that the Weekly Watch is easier for others to find. So another week of volatile markets driven by very similar themes of the past couple of weeks. We've had a lot of concerns around Russia's invasion of Ukraine and its impact for growth and inflation and central banks' response to that crisis. This week has very much been US and Fed-led, a bit of a tongue twister. So I'm very happy to be joined today by my colleague Kevin Cummins in the US to get more on that. But before we do, a quick recap on the major themes and our thoughts this week. In rates, we've had volatility driven by fears of stagflation. We've had markets that are increasingly worried about the prospect of the Fed engineering a hard landing. And we're starting to hear some increasing concerns of that on the UK front as well. Readers of our strategy notes will know that last week we turned neutral on US rates for the first time in nearly 2 years as these growth concerns increase. I should reiterate, though, that it's not our base case that we see a recession in the next few quarters, just that markets will increasingly worry about one as the Fed aggressively tightens into a decelerating growth environment and against a stagflationary backdrop. In Europe and the UK, it's been central bankers that are seemingly more worried than markets seem to be and starting to sound a little bit more cautious about these growth risks. And that's obviously causing some monetary policy divergence between us and across the pond. We've had front ends, though, that are struggling to price in this divergence and perhaps struggling to believe relatively how little the ECB and the Bank of England might react in rates, with the Fed going at least 25 basis points at every meeting between now and the end of the year. We continue to think that European markets, and by that I mean both Europe and the UK, are pricing in too much in terms of reaction function from central banks, and pricing this out should lead the way in steepening curves. Over the last couple of sessions, that is what we've seen, because not only have the Fed, reiterated their hawkish policy stance, but their focus on quantitative tightening, or QT, has focused global markets to quantitative tightening, and also what this might mean for long end of the curve in Europe and the UK. In FX, we've seen these stagflationary concerns play out with the March euro-dollar strength reversing at the beginning of April. We've seen a generally stronger dollar given a growing wall of worries for markets. Like I said before, that the Fed will be tightening into building global growth headwinds. Our FX colleagues continue to expect euro-dollar to test cyclical lows, although they are keeping a close eye on the US curve, given that historically correlated with turning points for euro-dollar. So as you can tell from everything that I've said there, global markets are laser focused on the US right now and where and how the Fed might react. So I'm happy to be joined by US economist Kevin Cummins in a very timely week where we've not only updated our Fed call, but also had the minutes from the March FOMC meeting. So Kevin, perhaps before we go into the minutes, since the last Weekly Watch came out, you've updated your Fed call. So could you talk us through that?
Sure. Yeah. We had the employment report on Friday, and it indicated, continued strength in the labor market. By all indications, even this morning, we had another really a 54-year low in initial jobless claims. So by all indications, the labor market is really super tight, and we're concerned that this is leading to upward pressure on wages, which will spill eventually over to inflation. So inflation is the key metric that the Fed is obviously most focused on now, so that we pushed ahead and moved kind of more in line with the hawkish rhetoric that we've heard from several Fed officials since the March FOMC meeting. So now we're expecting a 50 basis point rate hike in May, followed by 2 additional 50 basis point hikes in June and July. At that point, we do think that the Fed will dial back the pace a little bit by hiking only 25 basis points in September, November, and December, and carrying that pace on a more quarterly approach in 2023. Obviously, that's a long ways away, but as exhibited in yesterday's FOMC minutes, as well as the rhetoric coming from Fed officials, the message is that they want to be very aggressive, at least over the next couple of meetings. So that the market's expectation of a 50 basis point rate hike was very much crystallized in the minutes that we got yesterday.
So you mentioned the minutes, I suppose, with a view to rate hikes, but what about on quantitative tightening? Because that's the other key theme, I guess, of heading into the meeting next month, and also key theme globally, as I mentioned earlier, as global markets are following central bank balance sheets.
Yeah, there was certainly a pretty meaty discussion on the balance sheet runoff in the minutes. I think with regard to the details that were provided, most participants, I think it was categorized as monthly caps of 60 billion on treasuries, which is pretty close to expectations, and then 35 billion for MBS, which is a little on the aggressive side, I think, relative to expectations. So along with the aggressive rate hikes, I think they want to start on QT. They made it sound as if it's going to be very similar to the 2017-19 approach, but certainly much more aggressive than it was back then from the perspective of the caps. But the one thing they did do, they did stop short of announcing the exact timing of it, and it's debatable whether or not they wanted to try to perhaps potentially soften the blow on markets' impact of they are clearly focusing their primary tool for monetary policy is on interest rate side. So, the Fed raising the federal funds rate. And if the, profile, which they suggested is 50 basis points in May, and then perhaps a few more, depending upon the data, this may soften the blow a little bit, that buy them a little bit more time if they see the need to. But I think, it's not going to withstand, probably get in the way of them announcing the program in May. How quickly the implementation is, we'll see. But they did stop a little bit short and say it's as early as May. So that's very much consistent with the chair's monetary policy post meeting appearance.
And just to go back to your updated Fed call, you feel like that was vindicated, obviously, by the minutes that we had yesterday. How does that fit either versus market expectations, but also versus the Fed's dot plot for how we see rates for the rest of this year and then in 2023?
Yeah, I think the Fed is certainly of the mindset that they at least want to get back to neutral. In the minutes they did mention, and this is something that Powell touched on in his post-FOMC press conference, that they may need to go restrictive. It'll all come down to the inflation data. The labor market obviously is very tight, and whether or not they eventually go into restrictive territory. Our view is that the economy can certainly handle rate hikes over the course of the next year and a half or so, even with the stepped up pace of 50 basis points over the next couple of meetings. Given the size of the upward revisions to inflation in their own forecast in the March SEP, the more aggressive approach with regard to inflation certainly seems like the Fed is certainly worried about inflation. There was, a lot of references that fears of sustained inflation is informing their decisions from even the context they've had. I think it was many participants indicated that their business contacts reported substantial increases in wages and input prices, and they're concerned that that's going to pass through to their customers without any sort of fallback in demand. So, I think, with the unemployment rate now all the way down to 3.6% and potentially even going lower in our own forecast, we've got it down to a little bit below 3.25% by this year and 3% by the end of next year. The risk on inflation continues to push higher, and we saw that massive upward revision to the Fed's estimate of core PCE prices. Just looking back to December, they only expected 2.7% on a Q4 basis by the end of this year, and now that's all the way above 4% to 4.1%. So that's a very large upward revision, and the rhetoric led by the chair a few days after the March meeting at the NAPE conference along with most Fed officials that have come out and made public appearances, has been to push the envelope even further and really prep the market. So I think the bar is not high, or the hurdle is not high at all for the Fed. I think they've kind of used the language within the minutes that as long as inflation remains elevated or even intensifies, that a 50 basis point move could be appropriate as early as May and beyond. So, no matter what we get on April 12th, we'll get the CPI report. That'll be the only inflation data that they get ahead of the May 4th meeting. Even if, let's just say, it surprises to the downside, it is very soft. That'll be 1 month's reading. And, following the strength that we've seen in the last couple of months on the core inflation data, it really isn't going to be enough to prevent them from going 50. So I think 50 is certainly their base case for May. And you could make the case that they're going to need to see a significant slowing, not just in the year-over-year pace, but in the month-to-month increase on inflation. It's, the incremental change that probably is the most focused now for the Fed. That's something that Powell discussed in his post-FOMC press conference, that, we all know that the year-on-year trailing 12-month rate of increase is going to moderate in the coming months, assuming that inflation doesn't outperform what those really strong readings we saw last spring. So, the year-on-year will tick down, and the Fed's very aware of that. But I think they're more laser focused on the month-to-month change here and seeing the sort of incremental inflation that we get over the next couple of months. And I think, even if we were to get a softer reading for a month or two, that's probably not going to prevent them from being, of the mindset that they've, conquered inflation, and inflation's going to go back to their 2% objective anytime soon.
Yeah, that makes a lot of sense. All right, thank you, Kevin. I think that was all we have time for today. Thank you very much for joining me on the Weekly Watch, and thanks to all of our listeners for tuning in. We hope you have a great week.